What's up, everybody? Welcome back to the channel. You are now tuned in to Real Estate Money Media. I'm your host, Cornell Dane, and we've all together been diving into some of the news and some of the data that's been coming out about commercial real estate, about the economy. And today we're going to discuss something or review something or react to something that recently came out. A lot of people are uncertain as to whether or not the Fed is going to cut as aggressively as previously thought. I think Goldman Sachs was expecting 6 cuts. We're going to see now that some people are saying maybe it's going to be 4 because the data that's coming out is still strong. And as we go through this video, I'll discuss why that's important. But, a lot of us are depending on, especially in the housing market, in the commercial real estate market, we're depending on a cut to help us to kind of loosen up the market. We need more sales. We don't have any inventory. If we get rates to come down, obviously some of the folks that have a more favorable rate, maybe they decide, okay, this is good enough for me to sell my home. And then all of a sudden, maybe we get some action, we get some movement in the housing market. We also need some help in commercial real estate, as we've talked about before. Lower rates would allow folks to maybe refinance. And we're going to need lower rates for certain people because they've been, or maybe they were, overly aggressive when they purchased their property a year, 2 years, 4 or 5 years ago. So let's get right into it. This is a Yahoo Finance. This is, I think it's fair use. So let's get right into it and see what they're talking about.
Well, stocks are under pressure and Treasury yields climbing as investors begin to succumb to the reality that Fed rate cuts may not come as early or as aggressive as they'd hoped. U.S. retail sales this morning showing that the consumer remained strong to end 2023 despite slowdown concerns. We have Anthony Saccaro, Providence Financial and Insurance Services President, here to break all of this down. So, Anthony, how much of this is about the disconnect between Fed speak and market expectations versus just sort of a lot of people who sort of took those profits at the end of the year and just sort of clung on to the rally?
Well, the Federal Reserve has always said that it's going to be data dependent and they're going to make the changes along the way depending on what the data says. And when Waller spoke yesterday, he basically focused on the one thing that really has declined over time, which is GDP. That's come down. With everything else, when you talk about the labor market, when you talk about the strength of the consumer, when you talk about inflation spending, those were items that he talked about and then gave reasons why he thinks that they're going to slow down. He talked about the labor market and the fact that it's still strong, but the number of jobs per employee is coming down, so they expect that to weaken and to become more imbalanced. Consumer spending still up, right? December retail sales up 0.6%, but consumer savings are going down, credit card rates are going up, so they expect that that's going to go down over time. Inflation, is still higher than they want it to be on the PCE and both the CPI when you look at the year over year. But if you look at the last 3 months and 6 months, that's within a stone's throw distance of where they want it to be. So Waller did a compelling job of saying, hey, everything right now is in a great situation, but it's getting weaker. It's coming down, the metrics that we look at, and therefore we think that there are still going to be rate cuts. The challenge is, are they going to be as aggressive as the market is pricing in? And the Treasury yields are telling us that that's probably not going to happen. 60% chance in March that they cut the first time. I think it's what's being priced in. I have doubts about that.
So basically, I mean, that was pretty clear. What he's saying is that, look, it's all data dependent. The Fed's not, based on how they've reacted thus far, they're not going to be sure about whether or not a cut is warranted or not. So in March, when everybody's expecting this cut, they may not get it. The market may not get that cut, and if they don't, all kinds of things are going to happen. Remember, that's the spring season. The spring season for buying houses begins in about March. You've got tax season coming. You got a whole host of other things happening, and we need those lower rates, or people are expecting those lower rates for all different kinds of stimulus purposes, stimulus reasons for the economy and for their own pocketbooks, obviously. But he's saying that because it's getting weaker, but it hasn't quite gotten weak enough, pump your brakes, hold your horses. It may not happen. So let's see what he says.
Anthony, there is still a question about how much of that monetary policy has actually taken hold, right? I mean, that'll sort of determine the trajectory of the economy this year. We had some comments coming through from the IMF over in Davos yesterday saying 75% of the Fed's policy is now reflected in the U.S. economy. I wonder how you read that as you think about your investment case. How much further of a slowdown is there ahead?
Yeah, so Waller basically said yesterday that monetary policy is still tight, and that is very true. It is still tight. It's hard to quantify. Is it 75%? Is it 50%? Or is it 100% baked in? Right now, the numbers are going in the direction that we want. The CPI is coming down. The PCE is coming down. The labor market rate, if you look back at that a year ago, I think the ratio, there were 2 jobs available for every worker. And now there's only 1.5 jobs available. I think it's 1.4 jobs to be specific for every worker that's available. That number's come down. So the fact is that it's going in the right direction. And right now, the Federal Reserve has no reason to move at all. When March comes, if the data is still as strong as it is now, there's no reason for them to lower rates. There's going to have to be something that happens. Something's going to have to give in order for them to make a decision one way or the other.
So, I mean, that's self-explanatory. I don't think he really answered her question there, because she really wanted him to say how much slower, what kind of slowdown are we talking here? And to be honest, with all the headwinds that we have in commercial real estate, like he said, credit is already tight. We looked at another video a couple of days ago. We were talking about how private credit is now stepping in place of the banks because the banks are so tight and the standards have been raised so high. We still don't know, basically. And that's kind of what he's saying, but he just didn't answer it quite that way. There are some headwinds, though, and it could get really bad. And that's what I'm really concerned about mostly.
And Nancy, some of the risks that we heard coming out of Davos, Jamie Dimon citing his concerns about US debt, about geopolitical risks, as well as some of the financial risks that he thinks markets have gotten complacent about. David Solomon also voicing that, especially when you think of still ongoing conflicts, 2 years in Ukraine, Israel, of course, and then what we're seeing in the Red Sea. At what point do we get a better vision and an understanding of how the risks are being priced in, and how can people position themselves?
Yeah,
This is kind of another way of asking the same question, so it's good. Let's check it out.
All great questions. I'm not even sure that they're necessarily answerable as far as when do we get a better understanding. I think we'll get a better understanding when something happens, right? We just don't know. That's the thing is with the geopolitical events, especially, I think that's the number one fear that I have is that something could happen. We can't put a terrorist attack on U.S. soil out of the realm of possibility. We've had it before. It's something that could happen again. We've got 2 wars going on at least. And then intellectual wars going on elsewhere geopolitically. I think that's the biggest risk. The challenge is how do you navigate that risk? And what we're doing with our clients, and keep in mind, I worked in the fixed income space with people who are retired. What I'm focused on is investments that pay income, because the interest and dividends are something you can count on. And at this point in time, fixed income could be used as a capital appreciation play. That's something that hasn't happened or been available in over 4 decades. So I think whether you're retired and need the income, the high yield, it's a great time to lock in high yield. Or if you're growing up and headed towards retirement, buying some fixed income for capital appreciation and locking in a high yield at the same time, I think all that makes sense.
All right, so didn't mean to do that, but let's go back to this scene. So there are a couple things that he said at the very end. Even though you may not be fixed income, you may not be buying bonds or those types of instruments, what he's saying is look for opportunities for passive income, not appreciation. And so he's saying that there's some wonderful opportunities for his clients and the instruments that he's using. I'd argue that maybe there's some opportunities in commercial real estate. We see it happening. We see it coming. It hasn't happened quite yet. It's still a little tight, but the fact that the banks aren't going to be able to lend on all of this stuff because of the position that some landlords and owners find themselves in, especially how office is transitioning, be very intelligent and smart about the type of properties that you're looking at or or the type of the sectors that you're looking into, and take advantage if there is an opportunity there. There are some value add opportunities which we've discussed several times with adaptive reuse, and there are also some other opportunities that are gonna happen just by virtue of the fact that folks are going to fail and not be able to refinance. So I put that in the same category as looking for fixed income, as a fixed income approach or fixed income opportunities. I think we should continue to look for those. And then on top of that, we really won't know, like he said, until something happens. And that something is probably going to be in commercial real estate. We need to pay close attention to that and keep our eye on that. So I hope this video was helpful. Please feel free to comment below and to like and subscribe and hit the bell notification. And I'll see you guys on the next one. Peace.